Welcome to Echo 311, Study Session 3, Double Entry Principles and Trial Balance. Introduction. The whole idea of financial accounting is based on double entry principles. This aspect is based on the principle which is also regarded as dual concept of accounting. You need to master this session properly before you could be able to enter transactions appropriately in ledgers. Learning outcomes. At the end of this study session, you should be able to 1. Define double entry and double entry principles. 2. State the golden rule of double entry. 3. Explain the application of double entry. 4. Prepare account using double entry. 5. Define trial balance. 6. State the principles of trial balance. 7. Prepare a simple trial balance. What is double entry? The word double means two or twice, while in accounting, entry means recording. Therefore, double entry is regarded as a method of bookkeeping in which items of transactions are recorded twice in relation to debit and credit entries. The double entry principle states that for every debit entry, there must be a corresponding credit entry, and vice versa. That is, there must be credit and debit entries for every transaction. Double entry is formally known as Italian method. It is a fundamental concept underlining the present-day bookkeeping and accounting system. Golden rule of double entry. The golden rule of double entry stipulated that for every transaction, the giver and the receiver must be identified. In this case, the giver will be credited and the receiver will be debited. That is, credit the giver and debit the receiver. For instance, if Mr. Cole gives Mr. Jack 2,000 naira, Mr. Cole's account will be credited because he is the giver, while Mr. Jack's account will be debited because he is the receiver. Application and effect of double entry system. The effects of double entry principles in the books of account could be explained in terms of dual effect. That is, for every transaction, there must be credit entry effect and debit entry effect. Double entry is practiced using a ledger or a T account, which is divided into two folds or sides, with debit side at the left side and the credit side at the right side. Ledger is a principal book of account that permits the use of double entry system. The two important rules of double entry recording system are as follows. Asset equals capital plus liability. Total debt equals total credit. The following explains the application of double entry. Cash scenario. This case, when a transaction contains or involves cash, it must pass through the cash book account, through the cash cash scenario. This case, when a transaction contains or involves cash, it must pass through the cash account, e.g., paid salaries with cash, receives cash from Wale, etc. Check and bank scenario. Here, if transactions contain or involve check, it must pass through the bank account, e.g., bought motor van with check. Goods and stock scenario. In this case, if a transaction contains the word stock or goods, it must pass through sales account, purchases account, returns outward account, or return inwards account, e.g., bought goods with cash. Fixed asset scenario. If a transaction contains a specified fixed asset purchase, account must be opened for that asset, e.g., bought machinery on credit, etc. Credit scenario. If a transaction contains the word credit, it must pass through personal account, e.g., sold goods on credit to XYZ Limited. Loan scenario. In this case, if a transaction contains the word loan, it must pass through loan account, e.g., obtained loan from First Bank. Capital scenario. When a transaction contains the word start business or commences business, then capital account must be opened, e.g., started business with cash. Drawing scenario. When a transaction contains these words, withdraw cash for personal use or take stock for private consumption, it must pass through drawing account. Preparation of account using double entry system. Example: started business with cash of 1,000. Cash account is debited with 1,000 naira. Example 2. On the 2nd of October, bought goods on credit from Jacob, 500 naira. Sales account is credited with Jacob, 500 naira, and Jacob's account is debited sales 500 naira. Example 3. On the 8th of October, paid salaries with check 100 naira. Number 4. 11th of October, paid Lara with cash 200 naira. Lara's account will be debited with cash 200 naira. Example 4. 11th of October as well, paid Lara cash with 200. Bank account is credited with Lara 500 naira. Example 5. 15th of October, obtained loan from Wema Bank in check 800 naira. Loan account is credited with bank 800 naira, and the double entry is concluded by opening bank account and it is debited with loan 800 naira. Short exercise. Complete the table below by stating the account to be debited and the account to be credited. The first one has been done for you. Paid rent with cash, bought goods on credit from Williams, received check from Bill and Co., commenced business with cash. What is balancing account? This is regarded as a process in bookkeeping by which the difference between the debit and the credit sides of an account is ascertained and accounted for. Businesses always balance their accounts periodically, that is, daily or weekly. Accounts are balanced up by using balance carried down and balance brought down. The balance brought down is taken to subsequent period as balance brought forward. Types of account balancing. Number 1, balancing where there is only one entry at either debit or credit side of the account. Sales account. is credited with cash of 2,000. That means on the debit side, we have balance carried down of 2,000, and then under the credit side, we have balance brought down of 2,000 naira. Number 2, balance where there are only one entry at both debit and credit side. Example, Bola's account is debited with sales of 5,000 naira and credited with cash, with bank. I take that again. Bola's account is debited with sales of 5,000 naira and credited with bank with 3,000 naira. Balance brought down on the credit side will be 2,000 naira, and the balance on both sides will be 5,000 naira. Balancing where there are 2 or more entries at either debit or credit side. Example, the purchase account is open, and on the debit side we have cash 4,000, Williams 6,000, bank 3,000. And then we have total of entries on the debit side 13,000. On the credit side, balance carried down will be 13,000, and on the debit side the balance brought down will be 13,000 naira. Number 4, balancing where there are 2 or more entries at both debit and credit side. Examples, a cash account is opened, and on the debit side we have sales 10,000, Williams 20,000, bank 15,000. The total entry is 35,000. The total entry on the debit side equals 45,000 naira. On the credit side, we have purchases 12,000, salaries 5,000, and balance carried down 28,000. So both sides have 45,000, and then we have balance brought down of 28,000 naira on the debit side. Procedures for balancing account. 1, add up both sides of the account, that is debit and credit side. 2, ascertain the difference between the debit and credit side of the account. 3, take the difference of the lesser side of the account as balance carried down. 4, then add up both sides again, including the difference taken to the lesser side. 5, have 2 lines drawn underneath of the total figure at both sides. 6, finally repeat the difference again at the opposite side, but as balance brought down. What is trial balance? It is defined as the list of all credit and debit balances from individual ledgers to check the arithmetic accuracy in the use of double entry system in the preparation of ledger and accounts. Trial balance is prepared after all accounts have been balanced up with their respective balance brought down, either as debit or credit side. These balances are listed out and grouped into debit and credit columns. The total of debit and credit columns must balance to show a degree of accuracy in the use of double entry system while preparing those ledgers. Principles of trial balance. A, all assets appear at debit column. B, all liabilities appear at credit column. C, all expenses appear at debit column. D, all incomes appear at credit column. E. All sales, returns outward, and provisions appear at credit side. F. All purchases, return inwards, carried inwards, carriage outward, appear at debit side. G. All capitals appear at credit side. Summary. From this session, you have learned something on double entry principle and how to use this principle in preparing account. You have also learned how to balance account and also how to prepare trial balance. This is the end of study session 3. Thanks for listening.